Hey, what's up, everybody? Ricardo Nava here, your favorite mortgage guy. Just wanted to share your daily mortgage tip for today. I'm actually leaving an appointment right now, so I'm in the car driving, but it doesn't mean that I can't share some awesome mortgage advice with you guys, right? So today's tip is the lowest rate isn't always the best option. So let me repeat that. The lowest rate isn't always the best option. Now, I know you might be thinking right now, well, that doesn't really make much sense. Doesn't the lowest rate give you the lowest payment? Well, not always. There are programs, and we do have programs where you can actually opt in to take a higher rate and get rid of your PMI. PMI is your private mortgage insurance that you have to pay anytime you put less than 20% down. And since most people usually put less than 20% down, they're paying an extra, usually like an extra, $200 to $300 on their mortgage for that PMI, and you can get rid of that. So if you take a higher interest rate but you're saving a couple $100 on PMI, then yeah, you're gonna overall have a lower payment, which is why this is stuff that not everybody knows. Another reason why a lowest rate might not be the best option, we can also cover closing costs with lender credits, right? So let's say that you want, hypothetically speaking, these are just random numbers and not actual numbers. This is just for an example, okay? So let's say you can get $5,000 worth of lender credits to go towards your closing costs, but it's gonna raise your rate and maybe raise your payment about $80, let's say, hypothetically speaking, right? Well, if you do that, right? Or let's say you opt out of that and you say, you know what? No, I don't want the $5,000. I want my payment to be $80 lower. So then how long would it take you saving that $80 to recoup that $5,000 that you gave up? If you do the math, it'll take you years, right? And this is just a hypothetical example, but every time that I've done this for people, it usually works out to where it'll take maybe around anywhere from 5 to 7 years to recoup that money that you gave up. So if you're planning on keeping the same loan, not the same house, you can stay in the same house and have different loans throughout the years. Every time you refinance, you get a new loan. But if you stay in the same loan for more than 7 years, then yeah, it's better to take the lower interest rate and not take the credit. Most people, 90% of people, don't stay in their loan for 7 years. They refinance usually on average every 2 to 3 years. Okay, so if you opt out of that credit and you don't take the credit and you take the lower rate and then you refinance, let's say a year from now, rates drop and you refinance, then you lost out on money. You actually lost out on thousands of dollars by taking the lower rate. It's crazy, right? Doesn't really make too much sense. Well, if what I'm saying doesn't make sense to you right now, then I'm more than happy to go over it with you, explain it more in detail. But just remember that the lowest rate isn't always the best option. People, a lot of times, are always shopping for the lowest rate, but that's not necessarily going to benefit you the most in the long run. So that's today's tip. Go ahead and comment if you got anything else that you want to know about it. I'm more than happy to connect with you. Thank you so much. Have an amazing day and God bless. Bye.